With Netflix stock now back up over 60% from its April lows on the back of a return to subscriber growth, a lot of people are still speculating about what actually caused Netflix to lose subscribers in the first place. And Netflix's 75% decline from its 2021 peak brought out all kinds of conspiracy theories about the end of Netflix. Netflix's content is terrible, the binge model is stupid, or even Netflix has gone woke. Well, today I'm going to be telling you the real reason why they initially lost subscribers, why it's likely no longer an issue, and how the data demonstrating this has been freely available the entire time, which is why I had no issue putting a huge amount of my wealth into the stock at under $200 per share. This video is sponsored by Sharesight, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try Sharesight for free or receive 4 months of a yearly subscription. The shift in sentiment for Netflix really started to change this week when they reported their Q3 2022 results, which were better than expected. The company reported $7.9 billion of revenue for the quarter, which was up just 5.9% from the year prior. But even though that growth rate is really bad, a large part of why they're growing so slow is simply because of the foreign exchange rates between the US dollar and the foreign currencies that they collect most of their revenue in. And of course, while this is a real factor that does influence how much US dollars they have to spend on content that they make in the US, for example, it's really a factor that's outside of Netflix and other businesses' control, and it's also something that over time has fluctuated up and down. Interestingly, if you actually remove the foreign exchange impact, they grew by 13% year over year, which is still a pretty decent growth rate. But of course, the headline for Netflix is that the company has returned to subscriber growth with 2.4 million additions in the quarter. And even though that is a positive thing that they're now moving in the right direction, or they have at least for one quarter, overall, they've still only added about 1.2 million subscribers for the first 3 quarters of the year, or about 2 million subscribers if you exclude the Russian withdrawal, which wasn't really lost subscribers, just Netflix choosing not to be in Russia anymore. But even that, taking the best figure, 2 million subscriber adds for the first 3 quarters of the year, that's a stark difference from the 20 to 30 million that they've been adding in the years prior. And there's obviously been quite a lot of speculation about what is causing this decline, and most people seem to have landed on the fact that there is much more competition and consumer choice in the streaming space now than there was even just a year ago. And while I certainly do think that competition is a factor in Netflix's performance recently and going forward in the future, a much better indicator of what may be driving the actual decline in subscribers and the slowdown in the business is how people are spending their time. Because right now we're in the middle of an inflation crisis and all kinds of difficult economic circumstances all around the world. So we have to remember that there could be other factors outside of the business's performance within the industry that could be driving it to not perform as good as it has in periods where the economy was booming. So the best thing you can do is to actually look at the core data that matters. And for something like Netflix, which produces content and tries to engage its users, it's how much time are people spending on their platforms? And on that note, we actually got some new data both out of the US and now out of the UK for how Netflix stacks up not only against competition in streaming, but also against traditional linear TV such as broadcast and cable. In the US, Netflix now accounts for 7.3% of video viewing, which is much higher than all of their competition except for YouTube. And the interesting thing about YouTube is that also includes YouTube TV, which is essentially YouTube's streaming cable subscription. If you actually strip out that cable subscription from YouTube, their percentage is 6.9%, meaning that YouTube's core platform, when stacked up against Netflix, Netflix is winning in terms of engaging their audience. And this is just television. This doesn't include mobile devices and laptops and computers where people primarily consume YouTube. But I think that's really telling that at least in a television setting, people are still spending more time on a service that costs money than one that is freely available on pretty much every smart TV. And in the UK, they account for 7.6% of TV time, which is 2.6 times Amazon and 1.4 times Disney, Hulu, and Hulu Live. So while there certainly is more competition now, if you've looked at these charts and how they've changed over time, there is more competition, and these other streaming services are gaining a bigger share of consumers' viewing time. They're not actually stealing a share away from Netflix. In fact, the increased competition in the space, the increased value of services like Disney Plus and HBO Max has simply accelerated the rate at which people stop watching linear TV, like broadcast and cable, and start watching or spending more of their time, a bigger share of their time, on streaming. In other words, the competition is actually, in a way, helping Netflix, because now that there is more choice on streaming services, people are choosing to subscribe to more streaming services and just spend less time watching linear TV, and that hasn't hurt Netflix so far. It's actually kind of helped them. And then there's a whole bunch of other unsupported reasons for the decline, such as the binge model not being desirable by customers, and even more ridiculous, that Netflix has somehow gone woke because having a wide variety of content, some of which doesn't align with you politically, is somehow the whole company going woke. I'm sorry to harp on this point, but that stupid argument is like walking into a video store and getting mad that there's a Trump documentary on the shelf or something. Like, you know, you don't have to watch it. And well, you might argue back that, well, all of their content has gone woke and there's nothing to watch, and that's why it's an issue. It's not that some content is woke, it's that all of it is woke. And that may be true for you personally, but that really doesn't matter from an investment perspective. What I care about is broadly speaking, people are spending more time on Netflix this year than they did last year, and that's not any indication that their content has shifted in any negative way at all, whether it's woke or just poor quality or whatever it is. And remember, in the US segment specifically, which is where we're looking at this engagement data, Netflix has 2 million less subscribers now than they did at the start of the year. So they have a greater share of TV viewing in the US, which doesn't just include Netflix subscribers, it includes all households, right? They have a greater share of that with less subscribers, which tells you that the people who are remaining are watching at a far higher rate. And that means that it's very likely that the reason why people are canceling, or the small number of people who dropped off the bottom, it's very likely they're not canceling because of the quality of the service, but for some other reason. And that other reason is very likely price, considering that at the beginning of the year, Netflix did a price increase. And just look at the macro environment that the US is in right now. A lot of households are facing a lot of pricing pressure. And while it's certainly not a good thing to see the business go through any kind of issue, the fact that it's likely due to pricing during a period where pricing and cost pressures are at an all-time high makes a lot of sense and doesn't really feed into the narrative that over the long term, Netflix is dead or dying or anything. And more interestingly, it also means that Netflix now has the opportunity to potentially recapture those subscribers with a cheaper plan. And that's exactly what they launched last week with their ad-supported tier. The new tier will come in below the 3 existing plans, so below basic, standard, and premium, and will be the same as the basic plan, but it'll be $7 instead of $10 in the US, and will have ads instead of being ad-free. On the earnings interview, the management team talked about how they're expecting the unit economics to be about neutral to positive, which essentially means that they probably think they can get $4 to $5 per subscriber in ads, which will make up for the $3 they're losing between the basic with ads and the basic plan, as well as a little bit more to cover the additional costs that come with ad sales and that sort of thing. Netflix is planning to run 4 to 5 minutes of ads per hour. Those ads are 15-second to 30-second ads. And if we assume that the average user watches 1 hour of Netflix per day, which is actually an underestimation from some of the research that I found, but let's just go with 1 hour per day, then that means that the average user would see about 120 to 600 ad impressions per month. So for them to collect $5 on those 120 to 600 ad impressions per month, for them to collect $5 on that, they would need to be charging between $8 and $42 per 1,000 impressions. Put that in perspective, most broadcast and cable networks charge between $15 and $30 per 1,000 impressions, and there was actually a leak a little while ago that showed that Netflix might have been selling inventory at $65 per 1,000 impressions. The point of doing this exercise isn't to get to an exact precise amount that they're going to calculate and then project forward. What I'm trying to see is it very likely that they will be able to make more or equal to their basic plan? And given that it looks very likely that they will be able to at least match their basic plan, and if they are in fact selling inventory at $65 per 1,000 impressions, then they might even be matching their standard plan. But even if that's the case, the management team said that they're not trying to make a better offer that people switch to. They're simply trying to match their other offers and then recapture the price sensitivity cumulative subscribers that they lost through 2022. So if it is in fact true that the people who dropped out of Netflix, like their existing base, love Netflix and want to continue engaging with the platform, it's very likely they'll have a pretty good shot at recapturing those subscribers. And then outside of the US, where economic conditions are a lot worse in some regions, they may be able to offer those subscribers, again, price-sensitive subscribers, a lower offer that is more attractive, getting them into the Netflix ecosystem. And then over the long run, some of those subscribers will upgrade over time. So I think this is a very, very good thing for Netflix, and I don't really see how you can view it any other way. The toughest thing in investing is going against the consensus. For Netflix to be an incredible investment, you really had to have been buying it when there was extreme pessimism earlier in 2022. The interesting thing about Netflix was that the data has been there the entire time. The entire time Netflix, throughout 2022 and even before that, Netflix has continued to grab the largest piece of viewing time. That hasn't changed. We've only gotten more data more broadly now outside of the US to also support that. And that's really ultimately what matters in this business. If a company can grab a huge amount of attention for people, then people are going to be willing to pay a huge amount for that content. So that's the core driver. That's what ultimately matters at the end of the day for this business, for HBO Max, for Disney Plus, whatever it is. It's how much time do people spend watching their content. I love talking about these real examples that I'm investing in because they're great case studies demonstrating how you can apply the same principles to any other business. If you want to see my full analysis on Netflix, which I did at the beginning of this year before any of this unfolded, where I spoke in detail about how I valued the business going forward and why it has deep competitive advantages. If you want to see all of that so that you can see how I'm applying the principles to help you apply them to other businesses, then make sure you join our investor community. It's now open to the public and you can join down in the description below. But with that said, hope you guys have a great day. See you in the next one.